if you are sitting at the governance token level, like you said, Santi, is that that there's some value in being able to govern. What's the value in being able to govern if you're not generating some slice of the fees?
This episode is brought to you by Core, the brand new non-custodial wallet that offers a seamless and secure experience on Avalanche. You'll hear more about Core later in the show. All right, everyone, welcome back to another weekly roundup. We skipped the roundup the last 2 weeks. We had so many good guests. We were getting them out, but we are back with another roundup. And because we missed the last two roundups, we brought on a really special guest. We've got Brett Winton, Director of Research at ARK Invest. Brett, I've been following him for years, reading his stuff for years. This is the first time we've ever actually spoken. Brett joined ARK in early 2014 and has worked alongside Cathie Wood for almost 15 years since their time at AllianceBernstein. Brett, welcome to Empire. Welcome to our weekly roundup, my friend.
Thank you for having me. Pleasure to be here.
Yeah. Santi, the first question is going to you here. Today, here's the agenda for today. Here's what I want to talk about. I want to talk about markets. I want to get everyone's take on just what's going on. It feels like we are back. Risk is on. ETH is pumping. Bitcoin's going up. Things are good. I want to get your guys' take on what's going on there. There's some funny stuff happening in crypto with like narratives are coming back because price is coming back. Things like Aptos and Sui. We've got the L1 chasers are coming back. Uniswap, thinking about the fee switch. Lido is ripping on the back of a Treasury proposal. Coinbase, some interesting stuff going on there. And then there's some other news, a lot of variant just raised 450. Some other big news I want to talk about. I want to get Brett's take on some real world assets and policy stuff that he's looking at. But Santi, the first question goes to you. You just bought a home. I think you're comfortable with me saying that. If not, we'll bleep it out. But you were looking at a fixed versus a floating mortgage. And I'm curious how you made that decision.
Yeah, I basically went floating. I thought there was a lot priced in on sort of the fixed. And I felt that this was before yesterday, of course, but I felt that it was just too priced in. And so I decided to go variable with the optionality of fixing it at some point. And yeah, I just kind of went with variable. Of course, none of this financial advice. And if you're considering buying a home, you should do your own thing. But yeah, I wanted to, like, the idea of paying upfront, like, and fixing for a 10-year, I sort of played it and said, okay, I'd rather take the sort of time value of money, and like paying up front on the 10-year was just a little too expensive, I thought. And, I felt that at some point in markets, like, rates were going to probably come down a bit. And so I just kind of decided to play that. So I may look like a genius. I may look like an idiot. Who knows? I mean, we're still on very record low interest rates. And so I feel like it's still pretty compelling. Like if you have a 10, 30-year view. So anyways.
You're a gambling man. Brett, what do we think? Santi make the right move or the wrong move?
Yeah, I mean, I think directionally the right move. I think that at least from our perspective, it's pretty clear that the Fed is reaching the end of its at least marginal like tightening cycle. And so I think there is still a lot of investable assets out there that are holding out because of fears about risk. And if you think about like broadly what's happened from a macro perspective is a lot of the assets that we're focused on and you all are probably focused on are so sensitive to flows that kind of the marginal interest rates have been just slamming the assets around. And over the medium term, markets play a weighing game. Over the short term, they play a voting game. And so all of our markets have been subject to the voting game. Which opens up pricing inefficiency for the weighing game. Within the interest rate context, like Alan Greenspan, I think, said that there's a giant savings glut and it was causing all these problems. That's the reason there's a savings glut is because we have this insane idea that we're all going to retire at the age of 65. We're going to stop producing at the age of 65, but we're going to live, 30 or 40 years past that without producing, but still consuming. And so everybody needs to like build up their balance sheet to accommodate the fact that they're supposed to be able to still pay to, live and eat and travel for some like absurd longevity risk that's even getting longer. 65 used to be the retirement age because that's when people on average died. now it's like stop working and keep living for 40 years. And so that means you have to build up this big like savings excess above what you are earning in income, so that you have something to spend down over time. And we're still, despite kind of like a multi-year kind of asset expansion, off sides of that. And so what that means is you still have kind of like people trying to save money and pump them into investable assets. And so, I think essentially the demographics and would suggest that you're going to still have a lot of people buying yielding assets, and it'll compress yields over time in a profound way. And that's not over because of this particular business cycle. That's going to continue.
Before this podcast, I was reading Howard Marks' latest memo. It came out yesterday, and it's really fascinating. I think he's one of the more clear-headed kind of investors out there. And he references like Swanson, who was chaired the endowment at Yale and did some pretty interesting stuff, like investing in alternatives, and before anyone really did. And it's a great read for anyone. I think it's just like really good wisdom. It talks a little bit about Brett was saying, which is this idea of like, we kept talking about this in the podcast, which is if you have a longer than kind of 1 year, like 1 year time horizon, you start seeing really good entry points in things that you like before really trying to time the market. And I felt like over the last couple of months, a lot of people were becoming macro experts and really opining on this stuff, when the smarter guys were probably saying, look, we just don't know. And so it's not very wise to spend so much energy in the short term, where rates are going to be, next quarter or in a couple of quarters. I think, what we do best, I think, as investors is just focusing on long-term kind of thesis and trends, and then just invest behind that. So anyways, it's a good read. We should link it in the pod.
Yeah. And I think just expanding on that, it's actually easier to underwrite the medium-term horizon than it is the short-term horizon. Think of how competitive it is. The kind of whole hedge fund game is basically I'm competing on every 3 months. I'm paying my staff based on 1 year's performance. And so all of the incentive is shoved into this very kind of tight band of potential return, which means that, as an individual, like, are you really going to outcompete someone whose entire full-time job with all of the data resources at their disposal is to beat that 3 or 6 month window? It seems unlikely. You're better off playing over a time horizon where it's easier to underwrite the positions, and then you're not in competition with the maximally incentivized sharks. And it's actually, your investment thesis can be much more stable over the medium term. You can do like a large amount of work on a specific asset to understand what it's likely to be worth over the medium term, and then place your bet in appropriately sized for your assessment of your edge. Having to recycle that every month or every 3 months, it's incredibly hard work. Like, why subject yourself to that as an individual?
Yeah. The Howard Marks piece was really good. He said we can't know much about the short term. If we do know a lot about the short term, if we have an opinion about the short term, we can't have much confidence in it. And even if we do have confidence, we reach a conclusion, there's really not much you can do in the very short term, right? So if you take all those three things combined, we really shouldn't care about the short term. I have a question then for both of you guys. When you look at how crypto funds are set up, one thing that's interesting about crypto is it's made all these illiquid assets in the private markets liquid from day one. Which everyone says, in crypto is really good, but it actually has this like detrimental impact. If you look at how VC funds are structured, there really aren't like many private only illiquid VC funds. They're all these kind of quasi VC fund meets hedge fund because they've allocated to these liquid tokens. So Brett, like, does that, when you look at these crypto funds and how they're set up, these VC funds are almost operating as hedge funds. Does that have a detrimental impact because they become more short-term focused?
It could. I mean, I think that you would argue that more liquidity and transparency on essentially asset values conceptually, for one thing, it's inevitable and it's good from a like efficient markets perspective. And I think there's business pressure, there's media pressure that forces people to operate on a shorter time horizon than they actually rightfully should on behalf of their clients. So everything that we've done inside ARK is actually to expressly say we're not going to respond to that pressure, to insulate kind of the analyst and investment team from that pressure, to underwrite our positions on 5-year windows, to do top-down work so that we know that those 5-year valuations are well anchored. And I mean, I think that, like, let's go in another direction. The private markets, you mentioned Swinson, there's been flood of capital into venture capital for a long time, and the returns have looked great. And they not only look great to those investors in venture capital, they look like they're just up and to the right without bumping around, which is the ideal asset. It's like, oh my gosh, it just generates returns and it's not volatile at all. If you daily mark those portfolios, the volatility would freak those investors out, right? And I think it's inevitable that those portfolios move towards daily marking. There are more liquid secondary markets for private exposures. Crypto assets broadly, like, what are those going to do? They're going to securitize everything. They're certainly going to serve as a function to securitize all of these assets that weren't otherwise securitized. And so kind of like your ability to see marks on whatever you hold, like what is the value of your floating rate mortgage on a daily basis? You don't know now, but you could trade out of that into a fixed rate at some point in the future, like very efficiently, which means you'll be getting like a daily mark on this is the value of that choice. And so I think that the how investors insulate themselves from that transparency pressure becomes increasingly important. And so in a crypto asset strategy, you can, yes, have like the ability to trade, but then have your investors be locked up for some amount of time so that you're not under this, suddenly you're getting the call every week, hey, what's going on with this thing that's down 25%? I mean, I think that there's ways that you have to intentionally structure your business to prevent you from becoming subject to the media, political, client pressure cycle that ultimately disserves your clients.
Yeah. I want to, Brett, obviously, ARK has been kind of a pioneer in really, I think, producing some of the best research and making kind of really bold claims about the future. And in many cases, it's been right. I think, everyone is probably familiar with Kathy and Chris, who ended up leaving and started Placeholder. But what's your, would love to get your take on what's like the latest thinking on crypto internally on the firm. I mean, I'd be remiss not to say you guys punched out of Coinbase. That might be because of pressure of flows, or, have you changed? I'm curious on that backdrop, like what's the latest thinking on crypto, or the firm?
Yeah, I mean, I think that the high level, like the innovation of Bitcoin introduced true digital property rights ownership as something that could be possible. And we think of, like, there's this whole, hey, Bitcoin's going to take over everything. And then there's the actually, smart contracts is everything. And then there's the people that want to define Web3 as comprising all of those things. And I disagree with that claim. I think that there are 3 simultaneous revolutions that were catalyzed by the introduction of Bitcoin. There's a money revolution, and Bitcoin is essentially positioned to win. And so then our expectation for the value of Bitcoin over the course of this business cycle hasn't changed because of, what's happened due to the voting machine pressure over the past 12 months. It's still that over time, it's going to win the money revolution. And then that's, conditional on like single digit adoption amongst a bunch of entities that hold money. You end up with around $1 million a coin. Then there's the financial revolution, which is kind of encoded in the smart contracting space, and it's still massively interesting. And given what's happened in the market cycle, we think that in some ways, like the DeFi protocols have demonstrated their importance and robustness, and that there's accepting UST Luna, which I would argue was transparently like a failed concept. The all of the collateralized loans, all of the kind of liquidity protocols all survived and actually gave us better insights as to what was happening to the centralized firms, causing kind of the recognition of their failure to be accelerated and actually kind of accelerate the deleveraging within the space in a liquid way. And so we think Ethereum is well placed there, and that there's all kinds of assets like competing for kind of that level one smart contracting platform that will enable DeFi. And then there's everything that we categorize in Web3, which is more consumer facing NFTs. And it's how do you take digital ownership and transmit it into the consumer facing web, and what does that enable? So these are three things that can move at separate velocities and separate paces. I think the intersection with Coinbase and entities that are trying to stay on the right sides of regulation is really interesting and potentially challenging, in that if the innovation is basically I can securitize everything on earth, I can securitize movie tickets. And so it means that I can own a movie ticket and that has at least collectible rights that are ongoing for that movie ticket. And maybe they're going to airdrop me ongoing Marvel merchandise because it was the premiere to, some Marvel movie. And so suddenly that's securitized. Does that mean I have to, the AMC has to register with the SEC in order to sell me that movie ticket? Like, this is a hard, this is how we end up having to give our social security number in order to buy like an action figure, right? And so clearly that's not the solution we're going to end up in, but there is so much regulatory uncertainty that it's hard to say how it's going to break for the entities trying to provide those services today.
Yeah.
So our view on like what is the next 10 years of crypto assets hasn't materially changed. Like, where does the cash flow accrue to the companies trying to provide the services and compete for kind of the business opportunity that goes alongside those crypto assets? We're assessing that weekly.
Yeah. I'm curious how you've found crypto to be investable from an institutional perspective. This is something that, we keep hearing the institutions are coming and there's more infrastructure. We still don't have, an ETF. Nonetheless, you guys perhaps have been more on willing to take these kind of jumps and hoops, but I'm curious how much of that has evolved and how easy it is for managers to allocate to the asset class.
I mean, managers can allocate their solution providers. Today, we have solutions that we can provide to allocators to get themselves efficient exposure to crypto assets. And I think it is the right move for anybody that has long-term liabilities to get access to a long duration asset. And if you think like Bitcoin is essentially an infinite duration asset. So I think that like they should be. And the financial system is a system that charges money from clients to take risk on their behalf, and then is business structured in a way where it tries to take as little risk as possible. And so, institutional allocators in their job is to take risk, but the meta job they have is to not get fired and to not cause clients to come back and say, hey, why did you do this? And so that's the kind of battle in getting real institutional money into crypto assets, and even Bitcoin, which I think is probably the most understandable from like what it does and the potential it has in the world. In conversations we've had with institutions, there's a very kind of steep learning curve of what it is and why it might be interesting. And then once they cross that, then they get into, well, can we do this from a regulatory perspective? How, they have to do all the operational due diligence, what happens to, it doesn't help when like some underlying kind of infrastructure providers in the ecosystem suddenly look unstable. And so I think that I remember in March, we had someone who's on the institutional side say March of 2020 say, oh, the drawdown here has set back kind of the institutional clock by 18 months. Well, if that's really true, then this most recent kind of unraveling and deleveraging of the system has probably set back the institutional clock, 36 months. And if the institutions don't get there first, in some way, that's a better outcome because it allows people in developing countries that are trying to protect themselves against, inflation, and it allows like more individuals to get access to the assets before the institutional money comes in. So from a kind of actually distribution of the holder base, it could be net better for the world.
Last week, the SEC announced insider trading charges against the former Coinbase PM and 2 others for allegedly trading ahead of new Coinbase asset announcements. And then the SEC said that 9 of the 25 tokens that were kind of traded in that were securities. Then on Monday, the SEC is looking into whether Coinbase allowed its US-based traders to trade unregistered securities. Obviously, Coinbase is very adamant that they don't list securities, that they're working with the SEC directly. How much of your guys' decision to offload 1.4 million shares of Coinbase was because of regulatory reasons versus maybe problems with the business model versus there are obviously big competitors like FTX and Coinbase and Binance that are getting stronger versus DeFi and like competitors like Uniswap? Like, what can you? I don't know how much you can talk about it, but tell us maybe a little bit of the insights behind that decision.
Sure. You have to think of our trading activity as happening within the context of other potential options where to put client money.
The opportunity cost of holding Coinbase.
Yeah. So there's, there are other companies that have done poorly in the last week in addition to Coinbase. And so if kind of like 2 companies trade down by identical amounts and previously they were here and here in the portfolio, and then we have a scoring system for our companies. And if we're raising thesis risk on Coinbase, for example, and then actually we haven't changed our scoring for this other company, then that'll cause us to swap our exposure from one into another. I think the promise for Coinbase is to be essentially a vertically integrated financial service provider for all of these crypto assets. There's a danger that the US regulatory system could act in such a way that it punishes the best actor and then forces the activity onto entities that are essentially have arranged themselves to avoid the US securities regulation system. And so if you think about competitive vectors to exchanges, there's like offshore exchanges, there's kind of DeFi as an interesting, potentially where all of the activity gets shoved. And so within that context, if the SEC is showing that it's going to essentially dig in its heels and try to punish the best actor, so it hopes it has like kind of ramifying effects across the entire ecosystem, then it at the very least provides a lot of blocking and tackling that Coinbase's management team has to do to fend off that threat and to educate people as to, well, this is how these assets should be treated. But again, I think that the underlying issue here is we're going to securitize everything. So you can't have the 1933 securities law apply to everything. Like we cannot have movie tickets be deemed securities. It would be a crazy thing to do. And there are clear like business model opportunities in making movie tickets something that have ongoing value, that are concert tickets where you get like a small percentage of the royalty rights from the documentary that was made of the concert that you happen to attend. Why shouldn't you? You were one of 10,000 participants that made that documentary what it was. But if to do so, you have to, register with the SEC, then that business will never emerge. And so I think that recognizing that there can be a lot of friction taken out of digital ownership of things, and that will make a lot of digital things look somewhat like securities, and in some cases a lot like securities. And that, bill written in 1933 is not sufficiently expansive, or particularly one that doesn't, prompt a rulemaking that acknowledges that these are different assets with different characteristics could really set the US back.
I was having the discussion with someone who's not in crypto, more in traditional finance, and we were talking about this kind of like, how would you create a new kind of framework to categorize like, okay, it's not going to be called a security, because if you call it a security, you get like cornered into this weird, like very difficult mess. But you do need to have some sort of, there's certain things about what means to be a security that I think would be applicable to crypto assets writ large. This idea of information and access to information and fairness. And I think it doesn't apply to like a NFT of a movie ticket, if you will. But for other assets, I think there are certain components of that are relevant, at least in my opinion. I'm curious if you were to kind of like talk to a regulator, like how would you imagine something like Ethereum or another crypto asset, Solana, if you will, like how would you construct like this new category of securities for today's age? You know what I mean? Or not a security? I'm just curious.
Well, I think a lot, I don't think I can give you the perfect rule now, but a lot of the rules that have been written are designed by setting out like a category of kind of company that can do a certain thing. For instance, custody. Like a separate company has to custody the assets. Well, that's necessary, and the way in which custody is written is not written as in like take care of private keys, right? It's like written back when you had, paper stock certificates that you would have in a file drawer. And so if you continue to require there to be separate entities for producing different functions, when the entire kind of transaction chain can be transparently seen and audited by the market participants, then it doesn't make conceptual sense why you would require all of these different entities that then results in kind of the slowness to settle in our existing financial system. So I think what are the characteristics that are interesting about blockchains? It's like instantly auditable and instantly transferable. You know who owns what, when, exactly when they own it. And if the rules aren't amended to acknowledge that, then you're going to end up with just an inefficient system, a system that's very costly to run and operate. And so then the activity and the businesses will move into geographies that facilitate a more transparent system. Like going back to your mortgage, if like you as a US resident, in order to transfer out of that floating rate mortgage into a fixed rate mortgage, have to go back to your bank and go through the whole, kind of refinancing process again. It's like a very expensive, costly, legally burdensome, frictionful thing to do. But conceptually, you could get a DeFi contract that actually affects that switch for you instantaneously, much less expensively. Well, if that's available to people outside the US, but not available to people inside the US, that'll be bad for people in the US. And so, the innovation and security, there's two things it comes with. It comes with increased efficiency and then leverage cycles that blow up a bunch of providers. That seems like that always happens no matter where we do it. And I think within kind of like DeFi and the intersection with DeFi and kind of the securities regulation, it's inevitable you'll end up with more leverage cycles. I would hope that we continue to enable the leverage cycles to happen in a transparent and auditable way, rather than defining like, oh, this is the three entities that can provide custody for these assets. And so then, they get way offsides in some way that creates systemic risk.
All right, folks, this episode is brought to you by our friends at Avalanche and Ava Labs. They have just dropped a new crypto wallet called Core. You're going to be hearing a lot about it over the coming months. You can now be one of the first to try it out. Here's the reason I'm excited to partner with them on Empire. Right now, crypto wallets and browser extensions, they feel clunky, they feel non-intuitive. That's why Ava Labs built Core. It's a free, non-custodial browser extension that gives Avalanche users a seamless and secure Web3 experience across the entire Avalanche ecosystem. Here are a few reasons to try Core. Here's what I'm experimenting with. Number one, Core has intuitive dashboards with a unified display for all of your NFT collections, all your crypto assets. You can execute asset swaps directly inside the wallet. It's a really nice experience. Maybe you want to earn yield or borrow against your Bitcoin, but you don't want to do it on one of those C5 platforms right now. Core's native bridging functionality makes it really easy to bridge your Bitcoin to Avalanche's robust DeFi ecosystem. Last but not least, Core makes on-ramping super easy. You can convert dollars to crypto right now using the MoonPay integration. Just takes a few clicks. Download Core today using the link in the show notes. It's really, really nice. If you are interested in the Avalanche ecosystem at all, you have to be using Core. Download Core using the link below. Now, let's get back to the show. I want to pivot this into actually a conversation about Uniswap. which might seem like a unrelated topic, but I think it is related because the fee switch, you turn on the fee switch, there's kind of this claim that turning the claim to protocol revenue could infer that Uni is now a security. So just maybe a little background for folks who aren't aware, there's this long debate if protocol should take, and specifically Uniswap, should take a percentage of the LP fee. So Uniswap currently has 3 fee levels. You've got like 0.05%, 0.3%, and 1%. Right now, all the fees are distributed back to LPs. There's this debate if the protocol should take a percentage of those LP fees. If you look at the original docs from Uniswap, they do say it's possible that I think it's like a 5 bit fee would be turned on in the future. There are 2 primary arguments for why the fee has not been turned on yet. A is maybe they just want to gain as much market share as possible in the early stages. The comparison people make is like, just a lot of SaaS businesses, or even like the Ubers and Lyfts and Amazons of the day. You don't focus on profit. You focus on just gaining market share. Once you have the market share, right? Ubers used to be $5 in Manhattan. Now they're $50 in Manhattan because they got the market share. The second reason for maybe not doing it is the regulatory concerns. The concern being that a claim to protocol revenue could infer that Uni is a security. Brett, I don't know if you guys at ARK are mainly focused on ETH and Bitcoin and like Coinbase, or if you push further into the DeFi stack. But I'm curious I'd love to get your take on this situation if you guys have been following it.
Sure. I mean, I think at a very high level, we think of decentralized exchanges as potentially doing 15 trillion in volume by 2026, call it. Okay. So then if you imagine you're going to collect a 50 basis points fee off of that, or a 5 basis points fee off of that, right? Then that translates into a meaningful revenue that then you could say, hey, that's going to be yield off of Uniswap, depending on your expectation of share there. And suddenly it makes the token much easier to value. And it kind of reminds me of like the whole asset class is still emerging. There's still like people like Chris, when he was with us, he decided, well, what about network value to transactions as a way to like measure the value of these assets? And there's reasons that's, not a great measure, but at least it's some kind of measure that you can on a relative basis say, hey, what's going on here versus here? And, it used to be in the early days of equities, it's actually equities were just valued on dividend yield. I'm talking early days. Like every equity had to pay out dividends or else it wasn't really considered worth much. Nobody would buy for the capital appreciation and capital reinvestment. And then at some point there was a phase change where people realized, hey, if we let businesses kind of reinvest the capital into their business, then they can actually kind of grow their asset base more quickly. And so we will value kind of the underlying equity at more than just the book value of the assets that underlie it. And so by paying out a fee for Uniswap, it in some ways it can make it very easy to be like, oh, this is the value of this token. And kind of given expectations for growth and decentralized exchanges, you might argue that you still need to be in kind of like capturing liquidity mode, as in there's going to be some point where there's like 1 or 2 dominant decentralized exchanges due to network effects or decentralized exchange protocols. And you would rather forestall kind of actually collecting that fee into Treasury or distributing it to token holders for as long as possible to make sure you're positioned to like capture all of those network effects. So that's like my high level kind of response to it. And then but then there's the interesting dynamic of like, can I drive up protocol value by actually feeding some of these, call them dividends, into the protocol, which then kind of attracts more liquidity participants, even though they're accepting a lower fee. And, I don't know what the right thing to do is, but I think it's fascinating.
The number that you guys put, so you said 15 trillion by 2026 in decentralized exchanges?
That's our estimate.
And today it's doing what? Probably 100 billion roughly a month. Multiply that by 12, you're looking at probably $1 trillion. So we grow by like 10 to 15x.
Yeah.
Very rough right. Ballpark sizes. Okay.
Yeah.
Interesting. Santi, do you have thoughts on the fee switch and Uniswap? I don't know if you've been following this closely.
Well, full disclosure, I was an early investor at Verify. And so, I'm biased, of course, but I think this has always been certainly something that I think a lot of funds, it would be interesting how they vote or if they abstain from voting, just given the regulatory kind of sensitivity around kind of turning on fee, then does that make Uni a security? Or because, this has been sort of the governance token, and conferring kind of governance rights is kind of the more regulatory kosher approach, and has been for a while. Obviously, Sushi has had a fee kind of distributed to Sushi holders and stakers. But actually, like there's a pretty interesting discussion that happened 6 months ago, or perhaps more, with Hasu, that talked about this idea of, okay, the fees are accruing to a contract. Whether you're distributing that to holders is another thing, right? And so if you kind of look at it that way, a lot of startups don't kind of issue a dividend, even if they're profitable. Like high growth companies reinvest in growth. The question is, like, those funds are not really kind of being used, right? They're just kind of there accruing, is my understanding. I don't think like the Uniswap Labs like is using that to fund operations or what have you. But correct me if I'm wrong. But to my knowledge, it's just sort of accruing to this contract, admin contract. And so you're not doing that. Like, I guess those funds, like you could look at like the enterprise value of the protocol, if you will, and equity value. And then like, there's big cash balance that is interesting. But yeah, I think there comes a time and a place for a company, if it's spewing out cash flow, to distribute that to investors if it doesn't have, a better place to invest. Of course, I'm using all these terms that are, company and investors. And I think when you hear that in crypto, it kind of screams security. Again, we're back to this thing. So I think it's going to be an interesting precedent around. I'm looking at what our fund's going to vote on it, meaning like, especially Paradigm and A16Z are big holders of that. Maybe they're going to delegate that to, someone else, and then, let them kind of vote. But I think,
But even if the fees accrue into a contract, it's like then your right of governance over that contract certainly has increased in value.
Correct. Yeah.
And it's kind of like what, again, it gets back to kind of I think underlying security law question, which is, what are we really trying to restrict here, right? And it's if kind of like it's open to operate on the protocol, there's like it's very transparent what's going on, and actually insider trading laws apply regardless of whether or not anything's a security. The DOJ charged the Coinbase people not having to say this was a security. It was just basically committing fraud against the end buyers of the assets, right? And so I think that there's it seems to me that there should be that protocols trying to kind of like, particularly on a like decentralized protocols, trying to like make governance decisions on the basis of whether or not collecting this fee actually turns them into a security are not going to be very satisfied with kind of the SEC's treatment of them regardless. It'll either be like, well, you're a security anyway, or not. And I don't think it'll be on the basis of like this particular vote, would be my guess. Not legal advice.
I think you bring up a really good, I was gonna say, I think you bring up a really good point, which is, I think we should focus on what's the intent and what is the kind of the repercussion of whatever particular action. And I think if I'm a regulator, and I've sort of emphasized this, is where's the harm being done? If there is harm being done, absolutely. I mean, I think you should focus on that and say, okay, there is, is there a fair market, transparent market that allows people to kind of have the same level of kind of interactions you have in traditional markets, where, there are the SEC and Edgar and companies, there's a protocol and a process by which you publish information and a standard of quality that, happens in these markets to give people a fair shot. I mean, I think that is philosophically and very much in line with that, where I think the kind of regulators probably, I hope, and I think this is what they do, is there harm being done by not updating certain laws or treating something that is very new, treating like innovation with archaic laws, like for instance, the accreditation kind of rules. So many people have been kind of on the sidelines, not being able to invest in things they might be knowledgeable, but because of this arbitrary definition that they're not accredited. And of course, there's been some changes recently, but you're sort of left wondering like how much like opportunity cost, how much detriment, like how much who's so many people have been affected because of that, because you haven't really updated these laws. And I think that's kind of the, I hope that the regulators kind of look at that, right? I mean, what is the harm if Uniswap all of a sudden turns on this fee? Like, is that all of a sudden like, do you treat it as security? And then what happens? Like, where is the harm being done in crypto? Okay, of course, there's scams, there's like outward Ponzi. It's like this happens in every market. Like that's just fraud is fraud, like no matter where you find it. But I do sometimes wonder, like, what is the benefit of treating something a security or a commodity? Like I feel like it creates so much like friction and would create like it's sort of unnecessary, I think, in many ways.
Yeah. And accreditation is actually a really good example, because the reason you could imagine like ex ante, the reason accreditation rules exist is because if you're going to invest in a private entity, for example, there's like a fixed high upfront fixed cost to that investment, and from both the company side and your side. And so then the amount of money you have to put in order to do it is high. Right. And so then if somebody is below a certain net worth, then the implied percentage of their portfolio they have to expose to this risky asset is high. But if you take the friction out, if you reduce that fixed cost,
correct.
And you reduce it a lot, and so suddenly somebody can actually distribute a bunch of, bets that are proportional to their portfolio and appropriate given their desire for returns. Like they are appropriately balanced within kind of the total net worth. Then having some kind of like, you have to be above a certain net worth in order to invest rule, just it's wrong. It's basically like, you're only allowed to get returns if you're already wealthy. And so you can imagine like the initial reason to do that is because of the high fixed cost and burdens of the existing system as it existed. And all of innovation is driving that friction out. And so then those high fixed costs disappear. And then you just have a set of rules where, if you have a certain amount of money, you're allowed to make this investment. And you can still make it very small if you want. And if you're below that amount of money, even though it's right size for your portfolio, you're not allowed. And that's wrong.
Guys, let me pivot the conversation away from the regulatory side of things, but stick with Uniswap, because there's another, I think the more interesting thing here with Uniswap is actually the business model of these like tier one DeFi protocols, which is like, should they be these like public goods almost, or should they generate fees, and should they have revenue and spit off hundreds of millions or billions of dollars a year, right? And the problem with Uniswap today is that the value accrual, there's like a broken value accrual mechanism. And so there are ways that you can consider doing this, like licensing, right? Like uni licensing fees could be a significant revenue in the future. There's another thing, which is they could almost follow the DYDX model and move away from Ethereum, because there's this MEV that's getting accumulated, but it goes back to the Ethereum chain. Uni could create their own chain. I think Uni could also, I've heard that Uniswap is working on their own consumer app, right? So they could create their own app and almost like lock users in that way, compete with Coinbase, but then they kind of lose the DeFi side of things. So I'm curious, Santi, I don't know if you've thought a lot about just like these maybe not so much with Uniswap specifically, but like the Aves and Unis and makers, like, are these public goods, or like, do they need to figure out a business model that makes them long-term sustainable here? And if so, like, what is that business model?
I wouldn't necessarily agree that their business model is broken. I mean, Uniswap cranks out fees, they're just not distributing to holders. And I think there is value in governing over that. If you're Aave, for instance, there is a place and a need for a token to govern risk parameters. Now, of course, maybe it's sort of, not everyone should be voting on that. Maybe you should have a better system to manage that. But there is value in governing over these DeFi protocols. I wouldn't necessarily characterize them as kind of broken business models. Of course,
or maybe the business model's broke. If in any sort of financial services platform, fees ultimately go to zero, and you're seeing that with the Coinbases of the world right now. Like, you got to imagine fees go to zero with Uni. So then does it become
really.
like
Not really. No, I sort of disagree with that. This is like, there's some folks out there that like, look at what happened in the internet. It says there is a lot of public good infrastructure. There is a cost to upgrading and maintaining open source networks. Google giving employees subsidizing a couple hours a week for them to work and tinker on open source stuff. I mean, there's a cost. You just kind of don't see it, or like, it's not necessarily as tangible, sort of goodwill, if you will. But the whole premise of why like crypto is pretty awesome is the idea to tokenize something and allow you to capture value in other parts of the stack that weren't possible before. You know, like if you look at the internet, like most of the value accrued to the sliver of kind of more front-facing app protocols and those sort of companies, Facebooks of the world and Googles, that just sort of utilize, to your point, a lot of infrastructure that, you know, doesn't didn't accrue value, but you can tokenize now and create the possibility to kind of reward people that are contributing to these networks. So I don't think that like there's a common fallacy, I think, to like use analogies and how things happened before and say this is the way Web3 is going to develop. And I think that, look, it helps people understand something new, but I think you sometimes need to unshackle yourself from like that kind of like analogy and say it can be different this time, like in how things develop. And so I do think that there's going to value will be accruing to DeFi protocols. Yes, there is a lot of MEV that goes to, like, there's an interesting perhaps discussion around, are you better off investing in the L1, i.e. Ethereum, because that's where MEV ultimately accrues with the IP 5059 and all that, or should you be buying the governance token? I think that's a more perhaps interesting discussion. We had it with the guys at Multicoin that had the view that more value is going to accrue at the L1 versus DeFi. And look, DeFi has been in a kind of like, I think it was right now where DeFi has really traded pretty down over the last like year and a half. So, but I don't necessarily look at that and say DeFi is broken, it's dead, it's going to be a public good. And I don't also agree that fees will go to zero. There is value in using a trusted provider solution, i.e. Uniswap, over your other fork that may be absolute garbage.
Well, and by fees go to zero, I mean, you would still need to be providing fees to the liquidity providers, right? You're just saying, or Jana, you're just saying that the fees accruing to the protocol might compress to zero, right?
I'm saying that on on most financial platforms, whether it's like the old school, like the platforms that were built in the 90s, like the TD Ameritrades and E-Trades of the world, or more modern day, like stock buying platforms like those.
This was the thing when Robinhood launched, everyone said, "Oh, it's going to totally kill every other kind of Schwab and TD Ameritrade and all this stuff." The reality is, that was not true. I mean, there's a lot of. Again,
I'm not saying that it kills them. I'm just saying, like, for users, like, okay. So if you're a platform, you have to acquire users.
You have to understand that the apparent fees might go to zero, but the actual extracted value still remains. As in, like, take Robinhood doing payment for order flow, right? Where, like, so there. For a company where there's some fixed cost of doing business, right, you have to like generate revenue in excess of that to still exist as a company, at least over a sustainable duration. For a protocol, like you know, to attract the basically the liquidity for a decentralized exchange, you have to be paying out something to the liquidity providers, and you will continue to have to. And I think the question, or an interesting question, is if you are sitting at the governance token level, like you said, Santi, is that there's some value in being able to govern. What's the value in being able to govern if you're not generating some slice of the fees? Well, the value is that somehow I can affect the fees in a way that personally rewards me at the expense of others in some way. So if you're not, you could argue, if you're not spitting out some kind of thing into the governance token itself, then it means the person that's going to own the governance token is going to be the person that can, you know, drive a vote in some way that gets them a lot of personal stuff.
Yeah. I mean, this is the example. This is Audius, right? There was a hack that happened last week where there was the ability to upgrade the contract with a lot of governance to, like, this person effectively able to try and drain like the community fund out of 6 million and then totally dump the tokens and then pocketed $1 million. I think the interesting thing is these governance attacks, or let's call it just this governance kind of the ability to influence certain, like decisions and upgrade a particular protocol or modify a risk parameter that might be beneficial to you is interesting in the context where you almost are left wondering, switching costs. I think this is what you're getting at, Jason, which is switching costs are very low in crypto. You can go to Uniswap and then go to any. If Uniswap all of a sudden by governance ends up doing, voting in certain things that affect the user, then you sure as hell know that there's going to be an almost immediate response from a lot of people to go to another provider and there's just no, it's seamless to kind of move and use different parts of the ecosystem. In traditional finance, going back to the Robinhood example, people switching bank accounts, people don't like to think about this. Like, it's almost crazy, but people don't like to think about money or who they're banking with, and opening a bank account takes time. Getting a mortgage takes time. These are all kind of frictions that like will be stripped out of the system in a very material way. And I think you're seeing it in crypto and DeFi in particular. And so you're left wondering, like, how will, and this is maybe a topic, like, shouldn't rant on this, but how much of like consumer behavior is going to change, particularly in finance, because you're radically compressing a lot of friction that has existed in traditional finance by regulation, by jurisdiction. Like, we talk about shitcoins in crypto. I mean, there's like all these kinds of shitcoins, and they're called the Zimbabwe dollar, the Chilean peso, the Mexican peso. Can we just have Bitcoin instead? Like, I mean, in a very extreme case. So anyways, this is why initially, this is why I think like I became interested and built the DeFi thesis way back in the day, because I felt that there was probably no better, like, when you see friction, and you sure as hell know, like, you don't have an Amazon-like experience with finance. There will come a time where you can do that, and I think crypto is like uniquely enabling that. But anyways,
let me ask you a question here. So I like what you're saying, Santi. So like less frictions, more efficiency. So like right now, maybe I have my money with Bank of America or Wells Fargo. That's not the best place to do it, but like it's a total pain in the ass to move my money and create a new bank account that has a higher interest rate. When you decrease frictions, it creates capital efficiencies. So like when I have, because my money's now in my MetaMask or like Web3 wallet, I can move it around really, really efficiently. Liquidity providers' main incentive to take on an impermanent loss risk is the return on investment from trading fees right now. Those returns are already quite small, and they've been getting smaller since DeFi summer, I would argue. When you take those fees away from them in a hyper efficient capital world, those LPs are probably then incentivized to move somewhere else.
Yeah. Correct. Now, again, going back to what Brett was saying, if you have a thesis that all this volume is going to come, right, then even though the percentage fee might go down, I mean, you're sort of playing a volume game, and you might be indifferent between holding two assets. And so the impermanent loss concept is something that a lot of folks coming from traditional finance say, wait a minute, this is never going to work. Uniswap is not going to work. A lot of folks passed on the idea of having an AMM because they said the order book model is just highly more efficient. Like, we don't need to reinvent finance here, guys. Lo and behold, you sort of, again, this is consumer behavior. Like, you have to think about, like, from first principles, how is this going to, like, you're allowing anyone to be a market maker. And there's a pocket of investors and token holders that say, I'm actually indifferent between two assets. And so the idea of impermanent loss, while is mathematically correct, it misses the point that there are some investors in some market environments that actually providing liquid, like being an LP is great. Like, you're like cost averaging up or down a particular asset. And so it might be a really efficient strategy to accumulate a particular token without trying to time the market while you're earning some fees to offset that. So I think this idea of, again, by analogy, you look at the order book model and say, that's perfect. It's better mathematically. I get it, but it doesn't factor in this idea of it is democratizing access, being a liquidity provider, being a market maker for so many people that historically have not been able to. And so that in and of itself creates a lot of value for different people. And yes, creates a lot of consumer surplus for sure, but there's still value being created and accruing somewhere. It just doesn't like go to zero, I think.
I think one last thought here is on the, actually, I think there's one other thing, which is capital allocation. Brett, I'm going to turn this into a question to you about DAOs, but the lead up to the question is, I think there's a capital allocation problem here, and I think we're seeing that with DAOs, right? Like, if you look at a centralized company, one of the most important things a CEO has to be good at is capital allocation. Capital is allocated into three buckets at a company: organic growth, right? You build new products and services that are developed by the company. Second bucket is inorganic growth, like M&A, basically. Third bucket would be share buybacks. Share buybacks happen at larger companies where they can't figure out organic growth. They can't figure out the inorganic growth. They typically happen when you have a bunch of cash and you can't figure out how to grow your appreciate the stack by doing M&A or by growing it inorganically. So you're basically going to buy back the shares and reduce the float. If you look at the governance forums in Uniswap, there's a lot of pushback that if you're going to create taxes or fees that make you less competitive, less capital efficient, you should probably, this is a quote, you should probably have a rigorous plan of how you wish to spend those funds. But it's taken them a long time to put that together because you've got this DAO model. I've been spending a lot of time in the Maker DAO forums recently, and it's for anyone who spent time in the Maker forums, it's been a bit of a shit show recently. So I'm curious, Brett, to just get your take on DAOs. Are they the future? How like, what are your, maybe, I don't know if how much you guys have been looking at the governance side of DAOs, but curious to get your take on them.
Well, I think like broadly, direct democracy is a poor way to make decisions in a dynamic environment. And so how do you like what we look for in management teams is typically, a founder, CEO who can steer the ship with a lot of agility. Right. And it's because the pace of change is accelerating across all sectors. Technology is just like basically turning up the world's pulse rate in a profound way. And so then I think there's call it an open question within kind of DeFi world. Are you forced to have a DAO in order to be decentralized? But then it both exposes you to kind of like a bunch of risks of people operating on their own behalf within that distributed governance structure? And then does it slow down and kind of like calcify your ability to make decisions and remain competitive? I don't know. I mean, I think that in some ways it's like the glory of Bitcoin in terms of its like both positioning within the marketplace and the specific thing it's trying to displace is actually profound conservatism is better to win the race of money. And so having, a governance that can't, like, it requires massive kind of effort to kind of shift people off of the asset to change the way it works, is net better for that opportunity. But if you are operating in a space where there are protocols being venture funded because they're going after kind of different areas where they feel like the market is being disserved, where there's like a lot of competing even layers in the value chain, I would guess that leaving aside the regulation side, the protocols that are being run by someone who's like, well, this is the vision, this is what we're going to do, are going to win. And so then the balance is like, how long can you continue to do that without crossing afoul of securities law and everything else? If you have to in some way like get to decentralization in order to be considered not a security, in order to actually do all the things that protocol should be able to do. I think it's a hard question. So yeah, I don't know. I mean, it's like anybody who's, had a condo board or anything, like this is a recipe for not getting things done, is having a lot of people with input on it and kind of like, or a recipe for like concealing where the true power lies, where somebody basically like Sybil attacks the governance thing and like accrues a bunch of nodes so they have voting power so they can force things through. And then it's really decentralized, not truly decentralized. And so I just don't know how you kind of like pair off or match those two things.
Yeah. I want to pivot away from Uni for a second, away from DAOs. There's one other DAO thing, just because this is a roundup, I want to say just one thing I'm paying attention to. Lido is debating selling Lido from their treasury to Dragonfly for DAI to diversify their treasury. There seems to be this debate about the discount price used, the amount of Lido sold, lockup period. Lido is ripping. It's up 60% on the week. If folks are listening to this, I would pay attention to just what's going on with Lido, Dragonfly. I think it's a really interesting conversation around DAOs trying to get capital in the bear market and diversifying their treasury. It's funny, like you've noticed that, when a company sells equity, like they raise their Series A or Series B or whatever it is, there's a lot of excitement. It's like, all right, this company's booming. When a DAO sells their own tokens, which is effectively almost like a Series A or Series B or something, it's like, why is this DAO selling their own tokens? That's negative. So I don't know. I think I don't know if either of you guys have been paying attention to that, but I just wanted to call that out. I would recommend, we can put a link to the forum.
The initial proposal got rejected.
Right.
There was, of course, a precedent of them doing it, selling it to Paradigm way back in the day, and then other investors as well. Yeah, you're right. I mean, I think like it's interesting because there's this hodl mentality in crypto that I think is very toxic at times, which is look, certain investors have because look, everything's on chain, so you can monitor these flows and everything, but you sort of we either glorify hodl mentality and then vilify people that like take are essentially trying to manage risk. And this is actually a question that I wanted to ask you, Brett, which is when you do research and if you're deep in the weeds, like it's hard not to get excited about technology, like just full stop, whether it's crypto or just technology is what gets the human race out of trouble in the last minute and like pushes us forward. The problem is that how do you marry like excited about technology with actually like price and having a view on price? Because at some point it does really matter. I ascribe to the view of when you actually enter a position. Like, things could be a great company, but a terrible investment, or a terrible company and a great investment. So price largely kind of dictates that. And crypto, of course, you are in full price discovery, even a Bitcoin, and there's no like P ratios and all this stuff. Like, and so it's hard, like narratives, like, what you think can happen in 10 years happens in 3 months. And you're like, oh wait, like, what happens? Like you essentially need to manage risk, right? Should a gaming company in crypto that hasn't produced anything be valued at like on a fully diluted basis of like 5 billion? Absolutely not. And so I'm curious, Brett, how do you like manage like doing research and then like saying, okay, and being excited about all this and then saying, well, actually it might not be a good time to invest on this, and like the investor side of your brain and then the research kind of more intellectual side of it?
Well, I think the two are actually quite closely coupled in that often we will do research at the technology level and be like, okay, this is not going to happen in a time horizon that makes sense for us. Or it's kind of like, okay, we've done all this research and then we basically like, turn over the page and see what other people have done. And like, oh, our perspective on this market is relatively similar to the markets. And so kind of, we don't have an edge. It's probably all embedded in the securities themselves. So from the top down level, that's a comparison we do all the time. Like given our expectations for cost declines and unit economics in different sectors, what's this market going to look like? And then where are we relative to everybody else who've used some other, I'd argue, flawed methodology. And if we're in the same spot, then it's like, okay, I don't need to do more work on that. So that happens to us with some frequency, and we have to celebrate that. Like the analysts should be encouraged to like do the work, and deciding not to invest is as valuable as deciding to invest. Then at the individual company level, we take the company's 5 years forward and we say, what is the cash flow generativeness of this business 5 years forward? And if I were a forced seller to not me, but to a techno pessimist who's only paying for that cash flow at that margin structure with that capital intensity, what would they pay? And so historically, that's always been like massive multiple compressions to our expectations for the company. In the current moment, with some of them, it's like, oh, well, they're already kind of at a fair cash flow generative multiple. And so then we have massively differentiated expectations for top line growth. And so then we think that they're great investments. So, but I think I think people don't do the work to quantify things enough when they get excited about things. Like fuel cells, it is demonstrable that like fuel cells aren't going to become cost competitive with consumer vehicles within at least until early 2030s. And that even conditional on like a passenger fuel cell vehicle doing Toyota Prius like volumes from here to there in terms of like manufacturing scaling. So it's not going to happen. But that doesn't stop kind of people to be like, fuel cells are the future and all these fuel cell companies are great. And then you look at how they're valued and you have to embed an expectation that fuel cells get into passenger vehicles for it to all work. And even at the peak, when the EV IPOs and SPACs were coming out, like some of them we really liked and we assessed. But like Rivian, for example, it's a great brand and company, but we can't make the valuation work at all unless you have a aggressive view on their ability to deliver autonomous on top of their platform, which they don't really have credible plans for. And so then you just say, okay, well, we'll wait till it comes to a price where it hits our return on capital target. So like I think completing the work is actually translating it into the economic value, because whether or not the technology is going to come to fruition is in part contingent upon it being able to motivate capital into its continued development. So you have to be able to make that case, I think, for to even be excited about the technology. And you don't get them all right. So it's like you do all of that work and you're like, okay, and then it turns out, oh, you were wrong on kind of like the friction in this point, or commercialization friction is often a huge challenge. And so I think it's an important discipline to at least operating how we try to operate in the marketplace, where we try to, put out our research, we take long-term positions and points of view, and then try to like aggressively allocate client assets to technologies that are massively misunderstood today. And I do think a lot of people think that technology investing is as good as like EVs are going to be great. And so I'm going to invest in every company that says EV. And then you just ride this huge hype cycle without kind of being selective at all. So then the other thing we do is it's like balancing between technologies. Right now, everything is subject to the voting game. So all the technologies are traded down and traded up, but there's actually more diversification benefit to diversifying across technologies than there is diversifying across sectors, at least according to our research. And so like you're better off having like a technology diversification than you are sector diversification. And so that's how we manage kind of like the internal risk of like an individual forecast in our portfolio being wrong.
Brett, speaking of the hype cycle, we have reached the most hyped part of the episode, which is the rapid fire, the ending, which puts a smile on Santi's face. Santi, you want to want to put Brett on the spot and get into some rapid fire to close us off?
Yeah. So the rules are try to 5-10 second responses. So so there we go. First question: how many hours of sleep do you get?
Between 7 and 8.
Wow.
Santi, you always say wow to that. Are you getting like 4 hours of sleep a night? Like, what are you?
Man, anyone in crypto doesn't. If you get more than 7 hours and you're in crypto, I literally need to research your brain because, yeah.
I've gotten a lot more diligent about sleep hygiene. Like, if you think, I think it affects mental, athletic, everything performance. So I would encourage you to.
There's a great book called Why We Sleep, which takes me to the second question. What's like the most interesting book you've read recently or piece of content?
I'm right now reading Political Order and Political Decay, but before that, The Rise of Political Order, Origins of Political Order by Francis Fukuyama.
That's Francis Fukuyama.
Yeah.
Yeah.
It's that was supposed to be a 5-second answer, but it's a good book. And it's like thinking about how crypto assets can spur a new catalyze a new kind of political order is the context in which I think it's really interesting.
Will the dollar be replaced by something else, Bitcoin or another currency, in the next 5 to 10 years?
It depends on your definition of replaced.
As like the preferred kind of store value.
The global reserve.
Preferred store value.
Currency.
Yeah, unit of account.
Not preferred store value, like the global reserve. Yeah, unit account.
I think 10 years would be too aggressive to say it'll be displaced as a unit of account in 10 years, but I think that its displacement is inevitable over a multi-decade time horizon. I don't think there's nothing so special about the US that you would, expect that our economic system will be the pivot on which the world turns over meaningful time horizons.
No. Has inflation peaked?
Yes.
And then feel free to give a more than longer response here, but what is something that you wish you knew early on in your career as an investor or researcher that you know now?
I think when you first get into investing, particularly in technology, it's easy to dismiss kind of like distribution and commercialization friction. And so I think I don't know. I don't know do I wish, I really don't know.
You're more like you encourage everyone to learn by trial and error. Learn to know what they're good at and not, and that's a unique process, or like.
Yeah, I mean, I think the way that I've won and the way I encourage my analysts to win is just to always be in learning mode. And so it's hard to like maybe a recognition that you're always accreting knowledge, and that knowledge pays you back over a compounding time frame. But I feel like that's something
You mean like you never graduate?
Yes. Yeah, no. And I think that's really important. I mean, certainly it's important with crypto, and that's, you mentioned Chris. I think I said to Chris as he was leaving you've demonstrated to me that you can very quickly appear to be an expert on a new topic, but the reason why is because, you're like, all of these fields are so early across technology. Like the technological frontier is advancing so rapidly that it's actually like the guy who got a PhD 10 years ago is probably less expert than you, because he's burnishes his credentials on the research piece he did 10 years ago, as opposed to trying to remain like right at that frontier of knowledge and kind of learn and just like to develop the knowledge in the individual area. And I think that's and it's something that it kind of like, it compounds, like your ability to take on new topics and then compress them into like, how does this work from a first principles perspective, and then move to a different topic. You get a lot better at that. So yes, I don't know what I would tell my old self to like, I don't think, I guess the point is, I can't compress it into something that I could deliver back. Do you know what I mean? Like compressing all of the things I've learned there, it's like an accretion, not like a single insight. Right. And so then how do I compress it into a single thing that I deliver back without it being like trite and dumb?
Brett, how do, one of the core values at Blockworks is just curiosity. How do you guys hire for people who are naturally curious or like just lifelong learners? Like, is that baked into your hiring process, and how do you do it?
Well, we're not 100% successful, but I think that literally on like my hiring rubric, when I go through an interview with a candidate, intellectual curiosity, a score on that is one of the 4 things I track. So
how do you assess that? How do you quantify intellectual curiosity?
Well, I mean, on I think it's a 7-star scoring system. Maybe I use a 5-star scoring system.
Kind of.
So it's subjective, and it's running a candidate through a case question of a topic that they're familiar with, and then a case question and a topic that's kind of like outside of their kind of core competency is my typical interviewing style. And so you put them in terrain where they think they know everything, or they think they know a lot, and try to get them to like, try to basically like push them across a boundary where they actually, it turns out they don't, and see how they react and see how kind of the interplay works, and then put them in a terrain where they, effectively know nothing, and try to give them the basic information they need to try to construct the world as it exists in that separate terrain. And those, that's, so I don't know do you have an idea of how to measure kind of curiosity?
I used to run recruiting kind of for my group at JP Morgan way back in the day. And then I think one of the things, and this is some advice I got from someone when I was like going into my super day, is oftentimes you will be asked questions where they don't expect you to know the answer to. And they're just assessing, do you have are you a sufficiently secure person with confidence to be humble enough to say, I don't know, versus try to whiff? Because if you whiff, that's a really big red flag. That's, I think, what gets you in trouble in investing. As Mark Twain famously said, it's not what you know, it's what you think you know, but ain't so. And I think that to me is where you really blow up as a fund, like a long-term capital management, the mortgage crisis, like this idea that housing prices can never go down. And so it's that, like, I think that to me is, if you're not humble enough to understand that there are unknowns and factor into your thinking, you're at some point going to make a really bad assumption and mistake. So that's how I don't use a 7-point system, but that's to me one of the more important things.
Yeah, but see, I also think there's like, it's 2-stroke in that there's 1, people are naturally curious. 2, a lot of like education and training like tries to pound the curiosity out of people. 3, being curious is actually really hard work, and it's harder work as you get older. So you do need to like select for it in some way. So then 4, like typically people who've been through like analyst programs and investment banks, that actually diminishes their curiosity, at least in my experience. So they tend to fail out of our interviewing process a lot more frequently. And the environment in which you work and operate, that guides, creating an environment that fosters curiosity is as important as selecting people who are curious, right? And so kind of one of the assessments during the interview is like, how much is the person, like you said, it's not just like swinging and whiffing. It's like, are they seeking more information, and being meta aware of, okay, what is he trying to get at here, and where, how can I kind of show what I know and show what I'm capable of thinking, while also understanding what the problem is that I'm being confronted with. A lot of times people, particularly when they're under pressure, they'll just try to go on and on, or try to, they won't have that kind of interplay, which is really important.
Yeah. I think you're absolutely right in the point where when you go to college or these programs, you get ranked. There's this delayed gratification, i.e. the marshmallow test, is really powerful, because, it's oftentimes, especially in investing, you have a scorecard. Everyone has a scorecard. You want to be right. You want to be rewarded for being right. But to your point around compounding and accruing kind of these learnings, I think a lot of really intellectually curious people just always have that innateness of just, you're never kind of satisfied. You're constantly in this trajectory. And you never kind of reach an end state of okay, done. I took the test. I scored 100 or whatever. I'm done. It's more what could I have look back and say, what could I have done differently to get maybe to the same result? And sort of this constant desire to grow internally and do introspection, I think, is pretty key. But yeah, it's hard.
We've noticed that curiosity and passion are very linked, right? So if someone is very passionate about something, there's often the most passionate people are oftentimes the most curious people too, and they're
also maximalists, Jason. And stick to Bitcoin.
I mean, no, but I think Brett made a good point, which is the older you get, the harder it is to stay curious, because staying curious takes actually a shit ton of work. It means that after your workday, you have to dive into I don't know, I was watching this YouTube video last night on how MEV works, and that is I don't know, I think the older you get, the more responsibilities you have, the more busy you get, and I think it's quite hard to do that, and you only end up doing it if you're actually quite passionate about a topic. So even if it's not related to your work, we found that people who are inherently passionate about something can find passion in something else.
That's a good point.
So much for a fire round.
I know. This is
We've
so
literally deviated from the agenda and the plan and everything, but this is, hey, we're all intellectually curious, so we are allowed to go on these tangents. So anyways, I'll stop talking.
Brett, I want to wrap it with this one question. I'm going to tie it back to something Santiago said at the beginning of the conversation about Howard Marks. Howard had something else in his piece. He said, I'm just going to read it here. He said, if your behavior and that of your managers is conventional, you're likely to get conventional results, either good or bad. Only if the behavior is unconventional is your performance likely to be unconventional, and only if the judgments are superior is your performance likely to be above average. ARK strikes me as someone who has always been very unconventional. What are you guys doing right now in the investing landscape that you think is unconventional today, but is going to be seen as quite conventional 5 years from now? And what is something that you think everyone else is missing today that seems obvious to you?
Well, I go back to, I think people misunderstand the value of transparency in research. As in, there's a lot of entities that have tried to duplicate what we're doing, and they both, but just on a, hey, we're going to invest in aggressively in technology basis, but they don't enable their analysts to publish under their own names, don't let them operate on social media. And in fact, they think that that's marketing gimmick rather than something that delivers real value. I think you can see the pace of change in crypto is so fast, in part because the people are online and they're battling out these ideas and kind of they're putting out papers for people to respond to. And we're trying to do the same across all technology areas, where by allowing the analysts to generate a figure that they think is interesting, have it pass through our internal process of oh, this is interesting. Why is this interesting? And then as frictionlessly as possible, kind of post it for response and to figure out where they're wrong and where they're right, just increases our velocity in terms of being able to get to unique insights in the world, and understand kind of like the building blocks that lead up to those unique insights. And so like the thing that surprised me from inception to now, when we started, I thought I was just going to have a research team that would effectively duplicate the work that like McKinsey Global Institute and BCG had done, like end up at similar outcomes, but we would understand the mechanics better and so be able to invest on that basis. What's happened instead is we've generated, I'd say, more accurate forecasts over meaningful time horizons than these teams that have like, 5 PhDs on their papers, and they have, the 25 co-authors and, these big, expensive research efforts that these consultancies put out. And I think it's because we're like just on a much more rapid kind of intellectual advance cycle by being transparent about what we're doing. The world is full of data. We have a massive abundance of data now. And so your job as somebody who's trying to learn about things is to figure out ways to tune the data into kind of the information specific for what you're working on. And the only way to do that is to like announce to the world, this is what I'm working on, and provide them with nuggets of interest of what you're working on, because then the world feeds all of that data towards you. And so you tune anyway. Yeah.
Sounds like you're doing research in an open source, distributed and more decentralized. And that is, I've always told people that you guys are probably one of the best, if not the best, research shops out there. So very true to the crypto ethos of open sourcing information and knowledge. Not surprised why you guys love. We're one of the earlier ones to be very vocal about not just crypto, but other stuff as well. So kudos to you guys.
Brett, this was a great conversation, man. I appreciate you coming on. We'll link to your Twitter and ARK's website and stuff in the show notes. For anyone who's just listening, doesn't want to look at the show notes, it's at WINTON ARK, Winton ARK. Anything else you want to plug before we wrap this up, Brett?
We're putting out a Bitcoin monthly now. Yassine and team put that together. It's a great look at both kind of what's happened over the last month and some DeFi metrics, some custom to ARK. We have David Puel on the team who I think coined / invented market value to realized value ratios, and so doing a lot of on-chain research and development of metrics and new ways to analyze on-chain data in Bitcoin. I encourage everyone to check it out. It's a great, quick read.
Great. Amazing. Brett, thanks so much. Santi, as always, been a pleasure. And I will see you guys on next week's episode of Empire.
All right. Cheers.
Thanks, Brett. Take care.